Hey, good morning, everybody. Thanks for checking out my frosty flows this morning. I'm on a back porch this morning uh, because it's still kind of early and I don't want to wake up the whole household. But listen, well, the Fed did the right thing, I think, yesterday. They raised the targeted interest rate by 3/4 of a point, 75 basis point, and the market was real happy with that. It shot up after the announcement. But I think it'll be back down today, and here's why. Of course, I was glued to the TV the whole time the chairman was talking, and the rate increase was not the big news, I don't think, yesterday. Powell talked a lot about the SEP. SEP, I didn't know what that really was, but the SEP stands for the Fed's Summary of Economic Projections. To, to summarize what it took an hour for the chairman to say, uh, GDP is going to be lower. And gross domestic product, that's how much the country is growing, is the 1.7% is the current number. Okay, inflation is going to be higher. They're looking at 5.2% at the end of the year as the current forecast. And finally, interest rates are going up, folks. They're going to be higher. They're talking 3.4 to 3.5% by the end of the year. That's double what it is now. Pay off your credit cards. Um, hey, let's stop debating if we're headed for a recession. With those kind of numbers, we're headed for a recession if we're not already in one. Okay? The debate we need to be having now is how does this affect yours and my portfolios? I'm talking between now and the end of 2022 here. What's going to happen between now and the end of the year with our portfolios? And I really don't have a good answer to that. I mean, I wished I had a crystal ball, but I don't. What I do have is experience with this. Okay? This is the biggest rise in interest rates since 1994. And I've been up since 5:30 this morning thinking about this, okay? Uh, 1994, that was the time frame when I was coming out of the Air Force and going to work for Morgan Stanley. What do you do? How were we making money for our clients back when I first started at Morgan Stanley? Okay? There's an idea here. We used to use the dogs of the Dow strategy back then. It's a simple strategy. You buy the beat up Dow stocks that are paying nice dividends, have the highest yield. So we're looking for the highest yielders with the lowest prices we can find out there, and then you just sit back and wait for them to recover. In the meantime, you collect all the dividends. Well, that's for the Dow. What if I was to apply that to the Frosty stock portfolio and the Frosty ETF portfolio? You know, that might work. That just might work. Before I get too deep here, though, I need to spend the rest of today doing my homework. Remember, do your homework. Okay? So I'm going to go upstairs. I'm going to put the US Open on the TV in the background, and I'm going to crunch the numbers, and I'll let you know what I find out, okay? As soon as I have this figured out, I'll do another post, and I'll put out one of my Frosty golf ball posts, you know, the one for income and how to be a little more conservative and make some money that way. I'm excited about this, but I don't have the answers yet. I have to go do some research. So for now, Frosty out.